Charlie Munger predicts this will happen in 2023. How to save yourself. Hello viewers, welcome to my YouTube channel. Today in this video, we will talk about Charlie Munger prediction. What will happen in 2023? Charlie Munger, the billionaire investor and vice chairman of Berkshire Hathaway, has given his predictions for what he believes will happen in 2023. In an interview with CNBC, Munger said that he expects a very severe collapse in the bond market. He went on to say that investors should be wary of holding long-term bonds, and that those who hold them should expect a lot of price declines. So, how can you protect yourself from such a collapse? Watch this video until the end to find out Charlie Munger's advice for protecting your portfolio from a bond market collapse. Munger's comments come as a bit of a surprise, considering his usual optimism. Charlie Munger's predictions for 2023. In 2023, Charlie Munger predicts that the U.S. economy will experience a severe deflationary depression. Charlie Munger said that what we're getting is wretched excess and danger for the country. Everybody loves it because it's like a bunch of people getting drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. Eventually, there will be considerable trouble because of the wretched excess. That's the way it's usually worked in the past. His ominous warning comes on the heels of his previous warning of a lost decade for investors, emphasizing to investors that this is a concern that is clearly on Mr. Munger's mind a lot. To save yourself from this economic disaster, Munger recommends investing in high-quality assets such as gold and silver. He also advises against holding any debt, as it will be difficult to repay in a deflationary environment. Munger is also bearish on the stock market, predicting that it will experience a sharp decline in the next few years. He believes that many companies will go bankrupt and that the overall market will lose a significant amount of value. In terms of specific investments, Munger recommends investing in gold and silver, as well as in companies that produce essential goods and services. He also suggests diversifying one's portfolio across different asset classes to protect against inflation. 4 reasons why a painful crash is coming. First and foremost, interest rates are much more likely to head higher than lower in the near term, which, as his colleague Warren Buffett likes to say, means that the force of gravity on equity valuations will be increased. In fact, if inflation continues to rage near its current 4-decade high levels, there is a high probability that interest rates will be forced meaningfully higher. Second, with equity valuations already at nosebleed levels and the inflation rate soaring, the potential to generate impressive real returns is becoming increasingly challenging as multiple contraction is increasingly more likely than multiple expansion, and the high inflation rate sets a higher bar for corporate growth and dividend payments to generate a real return net of inflation. Third, building off of point 2, the Buffett indicator, one of Buffett's favorite metrics for determining how attractive the collective market is, indicates that the market is way overvalued and increasingly likely to generate disappointing returns moving forward. Last but not least, the wretched excess that Mr. Munger refers to in his comments means that, likely due to distorted interest rates, massive money printing, and government interference in the economy, there is gross misallocation of capital going on right now. Our top market crash portfolio insurance pick. With these cautions in mind and a desire to pay respect to Mr. Munger's track record for investing excellence, we are becoming increasingly cautious of a potential market crash and the ramifications it might have for our portfolio. Our top market crash portfolio insurance pick is Virtu Financial VIRT. It is a high-frequency trader that benefits from increased market volatility. It saw a massive surge in profitability during both the Great Financial Crisis as well as the COVID-19 crash. While it was privately held during the 2008 to 2009 era, its stock price soared even as the S&P 500 SPY, NASDAQ QQQ, Dow Jones crashed during the COVID-19 outbreak. We bought heavily between late September and late October at a weighted average price of $24.48. Since then, the stock has generated total returns of 54% while the SPY is up only 5%. Even still today, VIRT remains reasonably valued in a market of richly valued stocks, with a 10.8x forward P ratio and a 2.6% dividend yield. Even more impressively are its numerous high return on investment organic growth initiatives as well as its very aggressive share buyback program. In a little over a year since initiating the buyback program, VIRT has reduced its share count by 6.4%. On the most recent earnings call, the CEO expressed optimism that organic growth initiatives in areas like options, fixed income, and cryptocurrency in particular would continue to grow successfully and add to the company's baseline profitability. While VIRT is way up for us from when we bought it for our real money portfolio at High Yield Investor, it remains an attractive pick for portfolio insurance. It is essentially a way of owning the S&P Volatility Index VIX, but with the bonus of receiving a nice quarterly dividend and steady growth via organic growth initiatives, occasional strategic acquisitions, and share buybacks. Investor takeaway. While we have been very blessed to have seen our portfolio rise substantially over the past 6 months, even as the broader market has declined, we are not resting on our laurels or taking anything for granted. Given Charlie Munger's ominous musings concerning the stock market's outlook, we are being more cautious than ever. We believe that by overweighting dividend-paying stocks like VIRT that benefit from increased market volatility and have seen a surge in profitability during past market declines, we are able to optimize our risk-reward. How to save yourself from what will happen in 2023. In 2023, the economy will rebound and inflation will rise. The best way to save yourself from what will happen in 2023 is to diversify your investments and protect yourself from inflation. By investing in assets that will maintain their value or increase in value over time, you can safeguard your wealth against the effects of inflation. To protect yourself from inflation, invest in assets that will maintain their value or increase in value over time. Gold, silver, and other precious metals are good examples of inflation-proof investments. Another way to hedge against inflation is to invest in real estate or collectibles that are not subject to the same price fluctuations as stocks and other financial assets. Finally, remember to diversify your investments across different asset classes to further mitigate the risk of inflation eroding your wealth. Conclusion. In 2023, Charlie Munger predicts that there will be a major financial event that will have far-reaching consequences. To save yourself, he recommends diversifying your investments and having a mix of cash, stocks, and bonds. He also advises against putting all your eggs in one basket, saying that you should have different sources of income to hedge against economic downturns. By following his advice and diversifying your portfolio, you can protect yourself from the potential fallout of this upcoming event. So this was our today's video. I hope you all liked this video. Don't forget to hit the like button and subscribe my channel. And also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.